Hello traders, welcome back to your boot camp. It is currently day 6. By this time, obviously, you've gotten a lot of good foundational information that is going to help you to better understand what we do inside of CPSG, how we utilize the live rooms, and what we do long term. So today we're going to start to switch gears and really prepare you guys for day 7 through day 18, which day 7 through day 18 are very minimalistic sections. What they are, they're pinpointed into one area because things get so advanced I don't want to overwhelm you. And so today's section is really the last day that's going to have different information from different areas. And one of my favorite days is actually day 6 because today I teach you volume analysis and how to trade order books so that you can understand where other traders are putting their money and take advantage of it. Okay? So without further ado, get your notebooks out, get ready, and let's get started in day 6. So first things first, what I want to talk about just for a bit, and some of you guys may have already heard of this, some of you maybe not, is channel trading and trading inside of what are called channels. And so one of the things that you just learned to do from wick to wick in day 5 was learning to draw trend lines. And so when you start drawing these trend lines, you may find yourself just accidentally at some point drawing some trend lines and creating something that looks like a channel, a canal, a river, where it has two sides to it. And so channel trading can be very beneficial in all types of markets. And this can happen inside of trending or counter trend markets, and it can be used on all time frames. So for those of you guys that are trying to utilize the strategies that we are talking about in the short term, it should have just as much success if you use the proper portfolio management as a lot of us that are trading on, something more long term. So trade opportunities toward the outside of the channel are typically what you want to look for. And so what I mean by this is a channel, as you can imagine, think about it like a river or something. You have this edge of the river, you have this edge of the river. And here is price. The opportunities to trade the channel don't happen in here, but they happen out here on these circles. These are where the opportunities are best found, and obviously depending on trend, you're going to want to trade on the edge of the trend. So what I mean by that is if you find a channel trade that is in a bullish market here, you're going to want to only buy the dips of the channel, meaning buy these dips, not short these rallies. Okay, so the channel is not meant to confuse you. It's not a full-blown strategy. It's an enhancement to what you guys will learn as you get into the more pinpointed strategies such as the extension dip and sequential trading and things of that nature. So let's take a look at an abstract drawing of a channel, and then we'll see a realistic view of the channel. So on the left side, as you can see, obviously a bullish channel, and as far as these channels go, nothing differs. And what I mean by nothing differs is it's always just a higher high and higher low. And so you're still defining trend as the same, and you're still looking at the trend as in the same way. Okay, and so buying these dips, buying these dips, buying these dips, and of course I represented here on each side of the channel a breakout. And obviously breakouts are typically followed by what's called a retest. And what a retest is let's say this is the bottom of the channel, and then it breaks out. A retest, the market comes back into this, and this acts as resistance, and it bounces back. All right, so you're going to be looking for these sort of scenarios to enhance what is going to be taught day 7 through day 18. This is an enhancer. This is not a strategy. We by no means sit down in the market and say, today we're going to look for channels and channels only. We don't do that. That's not what we look for. Channels are simply meant to say, oh, we also found a channel on top of this, 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 and this. And so you're utilizing these channels for that. Okay, so from a realistic viewpoint, let's see what a channel looks like. And so in this channel, what you're looking for is, a couple different things. The first things first, this looks to be more so of a bearish market. So overall, this market is likely going to be a short or a sell to the downside eventually on the breakout. So we have to have that in the back of our head. But inside of that channel, what is the trend inside of this channel? And this is why a trend depends on a time frame. What is the trend inside of this channel? It's bullish, right? So if this is a bull market, your best bet is obviously you can trade either side, as it says here. You can buy off the bottom or sell off the top, but your best bet inside the channel is here. Once you get a couple more hits, the more hits you get, eventually it's going to break out. And so after you see it hit, say 4 times, 5 times, you'll start being more cautious, and waiting for the breakout. And so the unique thing about a channel and about MetaTrader 4 and about TradingView and really anything that you guys may be using is that we have the ability to draw the channel from point to point, such as right here, and then draw it to here, and progressively draw it out so that we can target the opposite side of the channel. So if you're shorting up here, okay, or going long down here, doesn't matter, you can target the opposite side of the channel and have a good idea of where it'll be. Now keep in mind, if I entered a trade here and I want to target the top of the channel, it's going to be kind of difficult because this would be the top, right? As you can see, it would have hit your target, but the channel continues to go up. So make sure that you're targeting usefully and knowing that this can happen. And so basing your targeting off of the channel itself, okay? And so as you can see here, based off of just where current price is, the target is much slimmer. In this case, it might have worked out a little bit better, okay? And so understanding further that you can mark support and resistance zones, and that'll further solidify these areas. And so you can see in those little little green lines there, the support and resistance that we have. And so these are good areas for you to watch the bounces to happen in the channel, okay? And when you can connect the dots and have multiple, support and resistance in a channel, and a Fibonacci level, and anything like that, and we'll get into some more advanced stuff soon. Anytime that you can get more of those, basically in the same little area, it's called confluence. And when we have confluence, and then whenever I refer to the confluence in a live room, or if you hear it anywhere else, when you hear the word confluence, what you need to be thinking is basically multiple reasons for entry. And you're always looking for that, okay? So the second type of channel is non-directional. So this is kind of, as you can see, we're kind of revisiting what we just learned in the day 5 series, but we're not just talking about a trending market, we're talking about channels. So in day 5, what'd you learn? We have a sideways market, a bullish market, or a bearish market. Same with channels. We have a bullish channel, a bearish channel, or a horizontal channel. And a horizontal channel are basically a sideways market or consolidation. Here at CPSG, we try to stay away from these ranges as much as possible if there's no clear trend prior to the consolidation. If we do have a clear trend, we trade in the same direction off of the support or resistance. Okay, so if you're confused what that means, let's talk. In this case, we have, as you see in the red line, a bullish market to the left. So you should tell yourself as you start to draw these, okay, I have a bullish market prior to going horizontal. If you have a bullish market prior to going in the horizontal direction, that is telling you that you should likely be trading off of the support of the horizontal channel. We only want to buy. So we're buying the dips in the range off of this support level. Okay? We're buying these dips. Okay? The range later, after this false breakout, breaks to these new highs on more support. So as you can see, we go up, we go horizontal, we continue higher. Trend up, trend up. Okay? These are important to understand. Same goes as follows if we had a bearish, followed by, supposed to be an arrow, sideways, and continuing. We're always looking for the market to continue what it was doing prior. The reason being, this is just buyers and sellers. So say we have only 100 traders in this pair, which is very unrealistic. But for sake of math, if we have 80 buyers and 20 sellers, of course the market's going up. Then it gets sideways and it's a 50-50 game. But who was stronger back here? The buyers. So they go back to this 80-20 game again, and it heads higher. The more buyers than sellers, of course, the faster this market continues to go higher. The reason it went sideways and maybe went down for a sec is more sellers came into play for a second. All right, but understanding that just concept here is going to help you as we start learning of volume analysis in today's section. Today you'll get a real good glimpse of some advanced information that is going to really, take you and give you, one of those feelings of wow, this is different. This is different. So another tool that I want to introduce just quickly, and once again, this is just day 1 through 6. His goal is good introduction to the tools, good introduction to the methodology of general principles of technical analysis. And then after day 6 is when things will get more pinpointed, shorter videos, pinpoint videos, and things of that nature. We're trying to really pinpoint down some things for you. So what we're going to learn about now for a second is Fibonacci. Now, a lot of people have heard of fibs, and if you've ever been in my live room at any point in time, if you're watching these videos, just learning the live room, if you're just joining, whatever, I talk about Fibonacci every single day. It is probably not a key tool, as I say there. It's probably the key tool to CPSG. If you don't understand this tool, you will not understand our advanced method, aka day 7 through day 18. And so the first type of tool we use is called the Fibonacci retracement, and it's used to find pullbacks in the market. And these are basically hidden levels of support and resistance. And so we use these retracements typically for entry zones and for entry levels. We do not use them for targeting because we have an advanced tactic using the Fibonacci expansion tool. So by nature, what a retracement is tracing back. So if you just drew a line and I told you to trace it back, but not lift your pen up right now, what would you do? You'd trace it back down. So a retracement is just that. If the market was going up and it's going to trace back, it'll just pull back. Okay, that is a retracement. And what you will see inside of what we're about to show you is that different levels of retracement, how deep it is, mean different things. Okay, so let's talk about some of the common retracement levels. And so the typical ones that you'll see me talking about are really these two in the middle, the 50 and the 61.8. However, these have meaning. And so first things first, what I want to describe to you is why what is 38.2, what is 50, what is 61.8, what is 78.6. The easiest one to describe is 50, and then it'll be clear for the rest. If you have a 100 pip swing, okay, this is a 100 pip swing to the upside, and it's going to retrace 50% of this swing. How many pips will it retrace? 50, right? 50 pips. Okay, so that's what a 50% retracement means. All it means is a percentage of this original swing. Same goes as follows. If you have a 38.2% retracement, it obviously means it's going to retrace less, right? And this is still 100. What would that mean for this? This is 38.2. Sorry about the red on the orange there. This is 38.2 pips on the pullback. And so obviously this is much faster than these. But what we like and what we utilize these with are support and resistance levels, trend lines, channels, trend, and as you'll see in the future here soon, volume analysis, as well as Fibonacci expansion. Now the 78.6 is too far out for entry for a lot of us, but keep in mind that many stop losses, meaning many traders place stop losses in this area. And so if it hits multiple times in this area, keep in mind it's not to be neglected against. If it hits multiple times in the 78.6 area, you know, okay, something's happening. And that's when you can actually look for more confluence at that level, but we don't typically use it a lot. All right, so let me show you an example. Here's a bullish on this big zoomed in version. This is a retracement here. And so what we're doing when we're using the Fibonacci tool is we're always drawing the tool in a certain direction. Okay, and so in this case, the market was what direction? It was up, right? This is bullish market. So when we're using our Fibonacci tool, what we're using is we're clicking and dragging. And I showed you that back in that video where we went MetaTrader 4 Basics. I showed you guys how to get Fibonacci. Go back to that video if you forget how to get to it. But what we do is we click on this and we drag up to the high. It'll automatically distinguish these levels for you. You don't have to do it. You can add any custom level you want, and if by default your brokerage firm doesn't have any of these levels, by all means add it. But it'll automatically spit these levels out, and it'll give you an imaginary support or resistance line for you to look. Is there an opportunity? Up here is the same picture, just flipped. But when it's bearish, we're clicking from the top and dragging to the bottom. And what I mean by that, once again, is the tool on MetaTrader 4. Click and drag, click and drag, click and drag. Write that down. Click and drag on the tool. And then it'll spit the level out for you. So when the pullback is shallow, it's a fast trend. When it's deep, it's a slow trend. The 50 and 61.8 are what we focus on. And that's what you're going to want to start focusing on when you're putting together all your reasons for entry. We haven't even learned how to enter a trade yet, have we? No. We are putting together all of our reasons still. So here's an example of a Fibonacci retracement. What I did was I drew this level, okay, from up here. I drew it down to right here. Okay, click and drag, click and drag, click and drag. What that then did was it spit out right here the 61.8 level and the 50 level and the rest of them as well. And so the importance of it is, say right here, as you can see, there's a level of support, turned resistance. All right, we have a trend line here that it bounced off of. We have a trend line here. So we're putting together these reasons for entry. As it says here, in a bullish market, you're drawing from the bottom to the top, and in a bearish, vice versa. Seen just here, you're drawing from the top to the bottom. And so this, once again, can be found in MetaTrader 4 like I taught you. Practice and rewatch the MT4 Basics if you cannot find the tool. But just practice this. There's no reason for you to jump in a trade, and try to find a trade setup if you can't even use the tool. So get in the habit of practicing using this tool. Click and drag randomly on your chart. See what it looks like. See what the numbers that are spitting out to you. And it's going to help you be able to move forward with your trading. All right? So I'm going to take a moment and pause here and just kind of give you a little note here. What you're about to learn for a lot of you guys will be the most advanced thing so far. For some of you guys, you may have been trading prior to this boot camp. You may not be beginners. You may be even, what many consider advanced traders. What I'm about to teach you is one of the things that really differentiates myself from a lot of retail traders, and that's taking advantage of free information on the internet to give you a chance, to understand what's going on in the market even better. And so now what we're going to do is get into volume analysis. Volume analysis is by far the most intriguing thing that's in the entire course. Why? Because many people have never seen it. That's the only reason it would be intriguing to people. And so, once again, this is considered beginner to an intermediate level compared to what you're about to learn, but this is going to push you a bit. And I really want you to sit back and really watch this and take a look. So here we go. We're going to learn how to use broker order books. Many technical analysts seem to forget to tell you that trading with the majority of traders, banks, and hedge funds will give you the highest chance to profit. If there's a lot of people buying the dollar, I want to be in on the train. The same goes with the stock market. If there's a lot of people buying, a stock of, a couple shares of Tesla, if there's a lot of people buying shares of Tesla right now, and, everybody's buying and the price is continuing to rise, it's a bullish market, I want to get in on that. So how do you know where they're trading? Well, today I'm going to teach you that. So first things first, CPSG has some access to bank orders, and it makes our trading lives easier. So that's what I utilize a lot of my analysis from, and that's what I utilize to help us out in the live room and give us our best chances and best reasons for entry. Many do not know this, but brokers also provide retail trading information of where to order at, or where the orders are at, I should say. Oanda is one of them. Disclaimer, what you're about to see is Oanda's orders only. It's not a representation of the whole market, it's a representation of the Oanda broker. However, when one broker has that, the representation is typically very close for the rest of the brokers. We use Oanda because they're a very trusted and regulated broker. We are by no way affiliated with them, and this is not in any way like an affiliation. This is just the tool that we have found online. This can be found by anybody online. So first things first, go to that link. I don't think you guys can click it, unfortunately. You can Google Oanda order book, or you can just type in that URL. It's, once again, oanda.com/forex-trading/analysis/forex-order-book. Okay. When you get to the page, you're going to see something like this in the front. This will be the main graphic you see. You'll see some other stuff, obviously. Maybe some advertisements. Obviously, it's a trading site and things. But this is going to be what's going to be predominantly on there. So this is real-time data of Oanda. And I'm going to teach you how to use this today. And this is really cool to use with your trading. On top, you can choose your currency pair. Now, keep in mind, they don't have all the currency pairs you may want to be trading. So that may be of, that's the only con of this, is there's certain times where I run into a pair that's typically out of my trading wheelhouse that I find an opportunity on, and I check the Oanda order book and it's not there. There's ways around it, by utilizing and looking at two different pairs, but there's nothing compared to just having, the pair in front of you. So for all intents and purposes today, we're going to be using the pairs that they have. And you click that drop down where it says Euro USD, and you'll notice that they do have quite a few pairs. So when you choose your pair, what I want you to do is always choose net. Okay, it zooms it in a little bit more accuracy. And then always click zoom for obvious reasons. I want you to be able to see it. This is a good price swing. These are, hundreds and hundreds of pips here. Good price swings. So zooming in is not going to hurt anything, because that's a big enough price swing for us to get the information we need. So first things first, on the right side here, these are open positions and these are open pendings. All right. What that means is that these are people that clicked market execution on the right, and these are people that are like me that used a limit or a buy stop order, a pending order on the left. So this means that a lot of people have pending orders to buy the market in this area. Open positions mean there's a lot of people currently short, and we'll get into that in a minute. But this is what the difference of them are. So understand the difference. This is the money that's currently actually being traded, and this is the money that is pending trades. There's a lot of people pending orders at those points. And so what we're going to do today is learn how to use these sections. So what can we take from this? Look on the right side first. So look right here. Okay, here's right side, left side. Look on the right side. Do we have more buyers or sellers? Take a minute. Do we have more buyers or sellers? Here's the short side, here's the long side. These are buyers, these are sellers. Do we have more? Okay, there's the peak here, there's the peak here. Okay, which one do we have more? We have more sellers, obviously. And what you can do is you can look down at the dotted line and say we have a little bit over 1.5% here, and we have under, 1%, maybe like 0.75% on here. So we have more sellers than buyers. And then look at the left side. Do we have more seller buy pendings? Clearly, we have more buy pendings than we have sell pendings. There's almost nothing here. Tons right here. All right, so what does this mean? Right, that is your, this is our main question. What does this mean? What can we do with this? So let's get into what this looks like. First things first. If we have lots of sellers at 1.06, approximately right here, we anticipate what direction will the market go? What direction do you think the market would go if we have a lot of sellers? Down, right? So we start to have an anticipation of the break of this support turned, or resistance turned support level. So if I know in the back of my head I have more sellers, then I can tell myself if I break this level and retest it, I may have an opportunity. Okay? And so then I look at it in this light as well. If I have a lot of pendings around this 1.0375 area, if the market decides to get back down here, what does that say? That if we hit that level, this market should spike back up. So these are notes that each day as you're looking at these that you should be taking. You should be writing it down in a notebook, understanding where is the volume. This is giving you the best potential chance of making money long term because you're trading in the right direction. All right, and the trend line here, this is just drawn. I just drew this so that you guys understood that, we will likely see a spike happen here. And it'll be interesting to see if the spike happens near the spike in price here, right? Okay, so this is how I speculated. This is just one way to use it. All right. So that's the first way of using it. They are meant to be used as guidelines to move, not to be traded with alone. The bank orders are 100 times better than this, which are basically intertwined into your DMS, your daily market snapshot. All right. So the daily market snapshot is basically taking those orders as well as trend bias and technical analysis and economical analysis and putting everything together to try to give you the best potential chance of simply trading in the right direction, because that is the number one battle that traders have. You want to make sure that you're trading in the right direction. So the second way of using these orders is by telling traders exactly where stop hunts can occur. A stop hunt is when a large institution intentionally spikes the market in the opposite direction to intentionally get traders going the wrong way. Now this is a touchy subject because stop hunts are almost talked about like a conspiracy. However, volume spikes do happen. Whatever you want to call it, it does happen. And so what I want to show you now is how we can read these. So if we have a bulk set of orders long here, and we also have pending orders short here, we have a unique situation occurring. And so I'm going to go to the next slide here. Same picture right here. Okay. Since we do not have any significant sellers present on the left chart, we can expect price to move very slowly right here to the downside. All right. Price is expected to move pretty slowly here. If price reaches that small spike of sellers, what you may see is a quick spike to the downside. And that is where still having this bulk traders long will be of advantage to you. Because we have bulk traders here. We hit this level, it gives us one little spike, institutional spike, and then everybody decides to go the other way. You make a lot of money that way. So you're always going to be wanting to look for these little spikes. Look at your charts for little spikes, and this is like that 1 bar spike, and you're looking for something over 1%. And when I talk about bulk, when I talk about a lot, 1.5%. Okay, so you're looking anything over 1% for these little spikes, and then for a lot of people, you're wondering what the underlying trend will be. Make sure it's over 1.5 to 2% on the bulk order trades, and it's going to be in a big price section. This is this is 1205 to 1195 on gold. Okay. So once again, this spike can happen because of this little pending order. Once it's hit, keep in mind, once a bunch of sellers get hit, what does the price do? If this bunch of sellers get hit, price will go down, 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 down. But we could see that spike to happen in the next candle, engulf it, and continue higher, right? So we want to make sure that we understand that. So what I want you to do is go to the Oanda book and take some pairs and take some pictures of them and mark them up and mark up your charts with it so that you can actually get an idea of what you're doing with it and how it's attacking. Okay, so understanding these, the channel, the Fibonacci, it's important. This here is now starting to get more advanced. The order book is more advanced, and I'm just exposing you to these tools to get you ready to understand everything for the method. and the extension dip and the golden zone and all that information. In day 7, what we will cover is intermediate market symmetry and candlestick reversals. It's a very easy day. It's just, pictures and things to discuss. But all of this is important on your way to learning the market. All right, so hopefully you guys have enjoyed the first 6 days. These first 6 days are typically the most grueling because for a lot of people it's a lot of new information. We will now take a couple more days of some new information, then it'll take a step back, and then we'll revamp, revisit, and really learn how to use these tools to actually enter a trade and actually make some money, and go from there. So I will see you guys back here for intermediate market symmetry and candlestick reversals inside of here on the 18-day boot camp on day 7.